even for companies that don't move physical things, the median SaaS multiple fell to below 5x forward revenue. So if you think about what's a company going to make over the next 12 months, that's usually a shorthand for what their valuation is. And so it fell to below 5x forward revenue. And based on the trends, as you alluded to, we may see this as kind of a before and after type event where the state of the economy wasn't the same, where we kind of chose to walk off a cliff, bit of a self-inflicted wound here. And on the point of like, why does this matter for tech? I was talking to an investor and I was like, hey, what's going to happen here? And he's like, well, companies that rely on global supply chains, like they're really fucked. They're not in good shape. And that all trickles down. Okay. So even if you don't move atoms, your customers probably do. And their budgets are about to feel like they got clotheslines.
Welcome to the Product Tea with Leah. I am your host, Leah Tarin, and we are about to spill the tea with the best from tech about product growth and senior leadership topics. All right, Chaos Crew, say hello to the Substack savage behind Mostly Metrics, where 64,000 executives go to learn where their spreadsheets lie. Ex-PWC, M&A gunslinger, private equity escapee, and now a full-time truth teller burning down tech's financial fairy tales. This guy's newsletter banked $500,000 last year while hosting a podcast because sleep is for the poor and the people who do not understand EBITDA. Oh, and Gary from sales still hasn't forgiven him for proving that hustle doesn't count as a valid line item. He'll break down why your cloud-based startup isn't immune to tariffs. Surprise, surprise. And why AI budgets are a CEO's midlife crisis and how VCs accidentally gaslight founders. Also, he drinks Miller Lite, which explains the dad jokes. Let's get uncomfortably smart. Welcome to the Product Tea, CJ Gustafson. How are you doing this morning?
Damn, that was an incredible intro. You deserve a Sirius XM show. I'm just going to say it.
Who can I replace from there?
I think Howard Stern's getting old.
I think he was old 30 years ago. CJ, did I forget anything? Was this a complete introduction of your personality and character, or do you want to add something?
No, thank you. I'm a tech CFO by trade, and now I make what I hope is amazing content online for my fellow nerds.
You do. I will speak on this in a second, but what do people get wrong about you once they get to know you?
So I think a lot of people just assume because I have a podcast and because I put myself out there into the scary world, like I'm an extrovert. I get like terrified of like having to socially go to things in real life or like running like a dinner. Like I just go through all these things in my head. Like nobody's going to show up. I'm going to say something stupid to the people who don't show up. I'm going to be hungover in the morning and not be able to get any work done. I just go down like this rabbit hole of like things that are going to go wrong. So my family's actually shocked that I have a podcast because like you can't get many words out of me at the dinner table, but I don't know. That's what I do.
We are very alike. And I have a question in this regard. So I also hate like these get-togethers in companies where you celebrate something that we just ship and then you're just standing there. And I hate silence, right? Like I don't really like it.
You fill the air with something.
Yeah, so just like starting to talk about some stuff that I actually don't want to talk about. I'm just like, how the fuck am I getting out of this?
Right. I'm talking about someone's like cats, and I don't even like cats. I'm just like, I need to talk about something.
Okay, what is wrong with you that you do not like it? We're not talking about cats today. But yeah, I can relate. But I think a lot of people are kind of misassuming that people who have podcasts actually are extroverts. But, you're talking about a topic, which is very cool for us. And then we kind of can get into it and we can pretend to be really smart.
Well, it's easy to talk about stuff that you're passionate about,
Yeah, that's true. Unfortunately, I'm not passionate about a lot of things that other people interest, specifically on these now I'm coming off really, I'm not coming off good. Okay, so CJ, one of the reasons why I wanted to talk to you is that I honestly really appreciate your Substack, your writing, and how explainable that you make things, right? So like even I understand it, even though I am one of those product peasants that do not understand finance at all. Specifically, you started when did you start? Like 3 years ago, 4 years ago already?
4 years ago, but nobody listened to me for the first year and a half, 2 years.
That is not true. If you go back in our conversations, you can see that I have reached out to you quite early.
An early adopter, as they say in product terms.
Yes, exactly. Because I actually do learn from you. And you are one of the people that I have contacted on around what's going on in the market right now. Not to just also explain it, but like to bring both of our perspectives a little bit together. So just for the people who are listening to this right now, today is the 16th of April, 2025. I feel like this is the first time we actually have to mention the date because you do not know what kind of crazy crap is going to happen in the next days. So this is the time where right now there's a lot of tariffs going around. Tariffs seem to be the new thing that we are using to just not tax people and so forth. And we also have a relatively negative outlook on the economy as a whole, I would say.
Yeah.
Why does this matter for people in tech when we are selling bits and bytes when these tariffs are applying mostly to common goods, like physical goods?
Yeah, totally. And it kind of put me into a mental pretzel as well because like I've always sold things that you can't touch. So I had to think about it a bit. And I guess to take a step back and just flesh out some of the context. So despite the economic evidence on like efficacy of like do tariffs work, dating back to even the time of Jesus or grain traders on the Mesopotamian plains, the US did decide to slap levies on all our major trade partners. And what you saw was overnight, it was a $1.8 trillion loss in global equities, which was actually the worst hit since COVID. And
Yep.
a lot of that's clawed back. So we lost 10 to 12%. It fluctuated. I think 8% as of today has come back, but there's still a ton of uncertainty in the market. And I'm not an economist. I actually struggled in that course. The whole supply demand curves were difficult for me to get my mind around. But I do study valuation multiples and how companies are perceived as being worth a lot or not. And the multiples took a massive hit. So even for companies that don't move physical things, the median SaaS multiple fell to below 5x forward revenue. So if you think about what's a company going to make over the next 12 months, that's usually a shorthand for what their valuation is. And so it fell to below 5x forward revenue. And based on the trends, as you alluded to, we may see this as kind of a before and after type event where the state of the economy wasn't the same, where we kind of chose to walk off a cliff, bit of a self-inflicted wound here. And on the point of like, why does this matter for tech? I was talking to an investor and I was like, hey, what's going to happen here? And he's like, well, companies that rely on global supply chains, like they're really fucked. They're not in good shape. And that all trickles down. Okay. So even if you don't move atoms, your customers probably do. And their budgets are about to feel like they got clotheslined. So like, you know who drops a bag on ERPs and CRMs? Nike. You know who like has their cloud spend cranked to 11? Lululemon. You know who probably buys a lot of FP&A tools? Ralph Lauren. Actually, they're probably still in spreadsheets, but nonetheless, like you will see it in procurement cycles where things start to slow down. So you always have to think like, who's my buyer and how are they impacted because it rolls downhill.
No, I think that's a very good summary as well. And I also want to a little bit make a little bit of a bracket open here. The point of also this podcast is not to make like, unsubstantiated panic or whatever, because there's also some people who are saying that, yeah, well, I guess 40 chess or whatever, or like it's going to be fine. Or like, yeah, as you said, like also like most of the losses have been reclawed to some degree. But a lot of this stuff, like especially like the stock market, everything from bonds to stock market to equity in general, everything has to deal with trust in the future, right? So like this is about stability. This is about like, do I believe that something is going to be there in a couple of years? And the way that we are usually thinking about it from the product side is anything that you do is not for the current market. It is for a market that hopefully is going to stay for 3 to 4 years. So for instance, if you see that COVID is ending, maybe don't develop anything anymore for a COVID market. I don't have a better example, but I think loss in this kind of trust is a big factor in all of the markets.
I think that the stock market is like a voting machine of our confidence in the future cash flows of the companies that are in it. And when that swings around, it means people are feeling uncertain. And you also see it in the credit markets with bonds. So bonds are linked to debt, and debt is completely built on trust, right? Like, are people going to pay that back? And I don't want to be like all doom and gloom. Like, there's always like when the economy zigs, another company can zag. Like, I don't think this is a net positive. I'll start at that. But like there are a couple companies or industries that could quietly benefit. So we were joking around about like and riffing on like luxury retail companies. There could be a huge positive swing for like re-commerce platforms like a Poshmark or a ThreadUp or the RealReal, because if you don't want to buy something net new, maybe you buy something used. And the same thing for like maintenance or workflow software. So like a Service Titan or an Upkeep or a Fix. Or like if you're looking for like parts for maintenance, like a parts discovery platform. So there always will be some industries that benefit, but like if you think about net new demand creation for goods, it's definitely uncertain.
What are you using yourself, like you personally, to kind of get a grip on this? Like everybody has their kind of tools. I'm using a very shitty one. So basically, what I do is I just watch HubSpot's stock because that's what I had a lot of investment in as a means of like seeing how SMBs are kind of like, doing. I know it. So this is not an index, it's just like one stock. But HubSpot has always been like a company that I feel like I understand what their business model is. I know how they work. They're very international as well, with having the majority of their business in the US. What is the stuff that you are looking into except for like leading the Tariffs in the morning?
Yeah, besides like newsletter headlines that frighten me in the morning, I do look at the VIX index. So it measures like the relative volatility in the market and how much it's swinging. So investors hate uncertainty. Like they don't like to put money behind things that aren't reliable or predictable. That's why SaaS has had such like a huge come up over the last 10 years, because the revenue streams were more predictable. But other than that, I try to look at the valuation multiples from week to week. And so every Sunday on Mostly Metrics, I actually put out an index of the top 10. And then what I also do is do the top 3 by sector. So I'll see how are marketplace valuation multiples trending? How are fintech valuation multiples trending? Because I don't want to like lose the forest through the trees either. I want to take a more nuanced approach of being like, different business models in different sectors are probably impacted a bit differently by this. So like an infrastructure company, that's going to be very durable revenue. Like you're not going to rip out Snowflake overnight, right? That would hurt your business. Or you're not going to rip out like your ERP necessarily. You might not buy a net new one, but like you want to retain your customers, which I'm sure we'll talk about. But I like to look at how the market's thinking about valuation multiples by sector.
I think that makes a lot of sense. And I just want to make maybe one additional note to this, in the sense of, you might be thinking as someone that is not really in finance, that the sentiment itself is just one part of this, right? So like we're talking about sentiment mostly right now, but I think there's a very important thing about this, that negative sentiment in a market can become self-fulfilling at some point. And that is when, one domino stone is starting to fall, and then, someone cannot refinance their business and so forth. So as you said, maybe right now, so in the beginning, yeah, sure, nobody's going to cancel a Snowflake contract. But if the company actually does go under, and this is how recessions work, they start to come up from the bottom up, right? Like first it's going to hit the very small ones, the bigger enterprise are safer and so forth. Then you do start to actually feel it. And all of this has started only because of a sentiment, exactly in the way that you said. Every investment is a sentiment in the end.
And people forget how non-linear the knock-on effects are. Like at first it's like nothing, then all at once. Like if you remember back in COVID, like it starts with, I think we have a supply chain problem and it started slow and then it's sudden. And then it's like, why can't I buy a desk? Why is it taking 10 months to get a desk?
I think that's an interesting one as well. Like for me, this is less about tariffs. It's just, it's just an unnecessary multiplier towards like how likely it is that a recession is coming. And maybe we can talk about this. So like if we move on from tariffs themselves, whether they're useful or not, I don't believe they're a good thing. But like even if you do not believe in this, and I think this is the key point as an investor, and let's be clear here, right? Like almost every company right now under the sun, especially in tech, has investors somewhere.
Yeah.
Unless you're like absolutely bootstrapped. So like a PE fund, like private equity, VCs, or whatever it is. So when you're thinking about it in this way, what does it mean if the risk in the market, without, a better upside as well on the same side, is just increasing? And why does it matter? Even if you might not believe in it, like that you say like, oh, maybe it's not going to happen, but we do see that the risk is actually increasing. So if JP Morgan is saying like, hey, there's a 60% chance of a recession.
I think what you're alluding to is that it all kind of trickles down into the capital markets and then deal flow. And people always use capital markets in hand wavy terms, but it's basically like, how likely are people to get a deal done, right? If you need money, how likely are you to get how much you need when you need it? And investors do hate uncertainty. And that's because they take the inputs of not only your company's performance, so that's the part that you can control, but also the economy's state, which is around interest rates and how much debt costs. And they input that into their fancy DCF models, which is a discounted cash flow model. And what it's trying to do is figure out how much money is this business going to make over the short term, medium, and long term. And what we've done is we've injected greater anxiety into the macro conditions on our own, which go into that, right? Like you still control how many customers you can try to go out or how many people you hire. What you can't control are the macro conditions. And that impacts the micro of the deals getting done. And so I take it back to, I worked with this fantastic guy at a marketplace. His name was Perry. And we sold aftermarket car parts. And he used to say, listen, like we're relatively insulated. Like if you're selling a note-taking app out there, like that may fully get denied. No one buys it. We were in a market where things would get delayed, but eventually like you got to get to work. You're going to buy brake pads. But I think in the case here, some deals will get delayed. Okay. But others will actually get denied. And so I think you should expect fewer board approvals and longer diligence cycles and more investors asking like, well, what happens if we have a scenario where like the price of a shipping container rate doubles again? How does that play into my model? So the net of it is the uncertainty is not great for models.
So specifically like with companies that have seasonal businesses,
Oh yeah.
like where you are quite dependent on something that is, a low occurrence during the year, like, I don't know, like tourist season or whatever it is. What that means, and I had a couple of these conversations right now, is that the investors who are actually having to front the money, well, it is their money in the end, are going to say that, well, like we're going to take a more defensive stance on this. And what that means is that investments during the year are now starting to be postponed exactly in the way that you said. So this can feel for the people like this, hey, we planned to start this in the next quarter, but now the board said no.
Yeah.
Because of the situation. That's what happens, right? And then if you're not doing it, there's also no chance that you're going to get an uplift from it. And that goes for all the other companies as well. So it's not just so much about also like what the negative outlook is, but like for how long is this going to stay? Because the longer it does, the worse it's going to get. This is just money that's not being invested.
And to try to make it like real of how it impacts a person, I was listening to the Prof G podcast this morning, and they had a good bit about like, what does it mean for college students? So let's say a company originally had headcount plans to increase staff by 10% year over year. They may delay that, and it may actually get denied long term. It's not like they're going to go out and hire double 20% next year once they feel good. It's probably going to be 10% again. So somebody who's about to graduate from business school in 2 months here, 3 months, whenever you graduate, I guess it'd be 2 months from now, they may have got their job offer rescinded because of this. Like they may not have a spot to go to because companies are like, I don't want to be risk on with increasing my spend.
This goes a little bit again, like into the discounted cash flow thing as well, like that you just said. I've never tried to explain it on air, but I think the principle behind this is that in my mind, most investors are always thinking on the 5-year scale.
Yeah.
Except in T's, they always like to think on 10 years because, within 10 years, we need to have the unicorn, but whatever. So the principle there is that $1 that you have today is more worth than $1 that you have tomorrow. So this is why we have metrics around CAC payback time, like how fast does an investment pay back in terms of a customer and so forth. So I will put an explanation into the show notes maybe as well, like on like what a DCF is. I don't know whether you have an article on it as well.
I do actually.
So I will actually link that one then. So that's a very good one to actually understand, because if you do not believe that in the next 5 years, the market is going to be so good, that means that you're going to keep more dollars to yourself, like to your chest in that regard. And it's kind of hard for people to really understand what that is.
It all goes back to the time value of money. Hey, there's one more story I just wanted to riff on real quick before we move on. So I was out in my driveway. I was walking the dog the other day, and my neighbor, he's a former hedge fund guy, and he now teaches at Rutgers. He teaches finance there. And he's like, CJ, this is crazy. So our school has Rutgers jerseys, like the football team wears jerseys. He said, we order those from Nike like a year ahead of time. He's like, with these tariffs, Nike is going to basically, like, their cost of production is out the window. He's like, do you really think Nike is going to make us jerseys and lose money on every single one? So he's like, what happens to that contract? Like, how does this play out? And he's like, something has to give there. So like, that just struck me as a real world example where schools may be buying something like uniforms for their players, and Nike has this contract that, like, because you got to think, like, Nike isn't running at the deepest profit margins in the world. If you raise tariffs by 25%, they may be, I don't know their exact numbers, but they may be losing 10% on every jersey now. So that's just a real world example of, like, it doesn't make sense anymore for them to do business.
That's a very good story, by the way, because also, like, we're used to, like, in SaaS, we have gross margins of like 80, 90%, like the really good ones. So like what that means is that out of $1, we can keep 90%. So I was having a board game store for 7 years, and my margins were about between 20 and 30%. So what that means is the tariffs or a tax in that sense is always like on the total price that you have in the end, right?
Yeah, you get wiped out with that.
Exactly. So a 20% tax on this is not 20% from the gains. No. It's on the entire price. So you're going to be completely gone. And the reason why this is being impacting them is that I think the way that it works also like in the US is when the goods actually arrive at the border. So not when they have been ordered or whatever. And now you have to understand the typical shipment of stuff that is being sent overseas is going to take 6 weeks. Well, 6 weeks ago, we had absolutely nothing. So what are you going to do, right? So like now you have ships sitting that cannot clear their cargo. So everything is incredibly interconnected. And right now there's this game of chicken being played. What can we do? And then we also have the logistics partners that are like, hey, yo, we need the ships for something else right now. Like we need to unload and clear this.
I'm not taking delivery.
So you will have probably ships that are just like going home again with the entire cargo on it. So you need to make decisions. It's really weird. We started to notice this as well, like when we were talking about providing solutions for energy traders. So energy traders are reliant on predictions about renewable energies, right? So like, let's say whether the wind is blowing or like the sun is shining. And you would think that, okay, so these are renewable energies. What has anything to do with this with ships and so forth? Well, it turns out if you have a prediction that in a specific area, the renewable energy will dip very hard because, there's overcast or whatever, then you have to send a ship with gas close to this particular market. So you need to make predictions, like weeks ahead.
It's hard to make predictions right now.
It's very hard to make predictions. And just because you cannot make these predictions is already a problem because some shipments will not happen. It's a physical world in the end. That's a good story, though. I'm going to check in with you like afterwards and like what happened.
I want to know if he shorted Nike. I got to go at lunch. I'm going to go see if he's around.
Yeah, ask him. And ask him whether like Louis Vuitton should also be shorted.
I will.
But we're not going to go into details on this one. So we agree that the outlook right now is a bit problematic, right? Like we're not in a recession yet, at least globally and so forth. And things are just not looking that kind of good. Now, you've been a CFO as well for most of your life, since you've been 2 years old, I think.
Yeah, came out of the womb with a belt and suspenders on.
Exactly. So what does that mean right now for a company or like a CFO specifically on it? Like, I don't know, let's just say like a smaller startup, like 20, 50 people, whatever. What do they do right now or what should they be doing? And maybe we can also split it up by PE, VC, and like bootstrap companies, like what the difference is maybe.
Yeah. And I don't want to just make it for CFOs either, because I think there are a lot of great like business-minded people within the company. Like the best product people I've ever worked with, like understand how the business operates when we get paid, because that like impacts the products we build and stuff. So sometimes you got to just keep calm and carry on. I hate to give that advice, but like this does fall into the bucket of things you can't control. But here's a list of things I wouldn't do right now. So the first one would be like hire super ahead of plan, because headcount is a fixed cost. You can't unwind that easily. So stick to your annual roadmap unless revenue meaningfully is outpacing it. So maybe you're in a sector where it is just doing better. Like maybe you work for Cursor and they're just pulling the product out of your hand. It's like, okay, you're the exception. The other thing I wouldn't do is sign massive multi-year contracts. So if you're a product person and you have a Figma contract up for renewal and they're going to offer you 8% off to sign up for 2 extra years, I'd be like, that 8% isn't necessarily worth 2 years of lock-in to me. So my equation for lock-in changes. So like, you got to give me at least 20% off. You got to make it worth my time and my risk now for a multi-year contract. And then I would start to review your budgets monthly, not quarterly. So a lot of people fall into the habit of like, yeah, we're going to review monthly. And then they're like every 3 months, every 6 months, they're reviewing. They get a bit lazy about it. Seriously, you should meet monthly, even if there's no news. And that can be good news sometimes. Like, so meet with your FP&A person, because the pace of change, like we alluded to, is going too fast. And then I would track pipeline exposure to non-tech customers. And this is more for like any RevOps folks or marketing people. Like go into your CRM and filter by industry, not just by SMB, mid-market, and enterprise, filter by industry within it. So I remember when COVID hit, what we did is we filtered for anybody in hospitality and travel. And then we actually came up with like a safe harbor deal for them, where if they became a customer, we gave them like 3 months free at the start. So in that sense, like the crisis can be an opportunity, because you offer them a deal where you're looked at as a value-added partner and they're like, oh shit, they see what I'm going through. I want to work with somebody who's going to help me onboard easier here. And then the last thing is just over-communicate with employees. Treat them like adults. Like be honest about what you do know and then what you don't. Because I do think that silence with this economic stuff breeds assumptions, and assumptions like rarely land in your favor.
I really like this. And you also made an interesting post about this a little bit tangentially, like, how to understand what you're actually doing inside of a company, like also like on the financial side, also like your own equity, like what that means and so forth. So I 100% agree with you. I remember specifically when COVID was hitting us at Small PDF, our business was exploding, like suddenly everybody needed digital documents. For some reason, not the entire world. So we were actually winners of that crisis back then. And it was very helpful to understand why or why not the specific things are translating into revenue. And there's still some old companies out there that just play their metrics very close to their heart. And I think good companies are talking about this quite a lot, and the best companies are also using it a lot. So, for instance, I would always expect my teams to also use these numbers in their planning in some kind of way. So, for instance, you would say that, hey, if we're deploying this, maybe we cannot measure it, but we do think that we can save over 2 to 3 FTE hires if this is actually working because we have less support tickets. Like actually think about it. So, what does that mean in terms of budget? And I have almost never had these conversations with product people, like in general. So CFOs are very close to this as well, but like usually the CFOs and their entire financial department is quite locked off, like it's,
Yeah.
oh, look, we have a closet in there. And that's where the finance people are smoking their cigars and doing the finance stuff.
Whenever somebody starts at a company in like the intro call, I just say, hey, would it be helpful if I explained how we make money here? Which sounds like a very basic question, but it's something that people are afraid to ask. And it goes to things like, this is how large our average customer is. This is when they usually pay us. This is the total addressable market we play in. This is how we price things. Because some people are like, oh, no, those are finance details. It's like, no, that's our monetization strategy, which plays itself out through the product, through all our engineering efforts, how we market it. And so if everybody understands how we make money, we're better aligned to the metrics on measuring like against that progress.
I find it incredibly hard right now to find good CPOs that are financially literate. And I don't mean like doing the job of a CFO. That's not what I mean. But like just like understanding. So for instance, I was always saying that I think a product team that does not plan for like 3 to 5x of its costs is not worth it because, like you also have a specific hit rate during the quarter. It also depends, of course, in which vertical that you're working. But like generally, 50% of our bets are failing. And about all of them are going to go over time. So you need to plan for more. Otherwise, what are you doing? Otherwise, the entire company cannot work. And doing this exercise with product teams is quite interesting because a lot of PMs start to kind of understand initially that, okay, I understand how much I cost the company. But funnily enough, like how much should we plan for? And like, what does it mean for my CFO to be happy with me, to not put like the red marker on my position?
Yeah. In my experience, the relationship between product and finance falls off the rails, and it's on finance to explain it. But it's when product is coming up with ideas of things to sell off the back of the truck that aren't unit economic accretive. So like we call it gross margin, but basically how much does it cost to serve a customer and what goes into it? So to give you an example, they come up with a brilliant idea, but we're reselling someone else's data in it, or it's like a huge infrastructure or workload cost in it. And so like it's a beautiful product, but it's like I can't sell this and realistically make money on it over time if it scales.
Do you think that CFOs in general, in today's economy, whatever that means, that they should be more responsible for making also, I don't want to call it product decisions, but like, like strategic product decisions in that sense? Because I have a very strong opinion on like the product needs to fucking grow up on this side, right? So like commercially, like, or is it more the product people that need to kind of become educated? I'm always a little bit torn between this one.
Well, I think the first step is that the CFO has to talk to product to actually understand it. So if you want to walk the walk, like you can't work at a security company and like not understand like how developers buy your product if it's a dev first motion or something. So like part of it is to have a baseline understanding because the CFO also needs that to tell a compelling story to investors. Investors can sniff out if you're at like a backup and recovery company, which I was at one time. I had literally no idea how the thing was built, what we sold. And I thought that I could just hide behind the numbers. And eventually I was like, I should probably have like a baseline understanding of what backup and recovery actually is, which wasn't easy for me to get my head around, but I had to do that. And then on the flip side, like I said, it comes back to how the product makes money because we're not trying to hang something in the Louvre, right? We're trying to sell something at scale and get better at it over time where the margins get better because that increases our profits, which increases our share value, which means everybody who has equity in the company gets paid. And I think that's the goal of it all at the end of the day, right? Like you want to build beautiful things, but you want to be rewarded for it.
Yeah, I think that's very true. I mean, on the equity topic, I always get a little bit of a twitchy eye because I feel like 90% of the people do not understand what kind of equity they have or like how it actually does work.
Yeah.
Now with LLMs, I hope that they actually do use them, right? Like upload your contract and ask the LLM, like, hey, what is happening if the company's being sold at this and this price? Because I had some shitty deals in my life that I did not understand, but it was nice seeing that I was owning 200,000 in equity, which was worth absolutely nothing if you were looking at the specific strike price and so forth, you know? So, but I think that's on that side. So you made before a couple of suggestions. Specifically, you said two things, right? So like you said, like hiring, for instance, is not a good idea right now. Or like, I mean,
hiring a head of plan is not a great idea in terms of like taking on more risk. I do think though, you got to hire great people to make a product so you don't like work yourself into a hole. What you don't want to do is pull back on everything because that's when you see like, oh crap, now we really got to climb out of something. And then you're just only banking on retaining your existing customers and the ball game shifts to how do I make that better?
Yeah, that makes a lot of sense. And I think you also said about something about the lock-in period. So like try not to go for multi-year contracts or at least say that, you know, like I want to have some goodie if I'm going to sign this particularly against the business. And both of these points are very interesting to me as well, because specifically on the hiring side for Europe, this is even worse because of labor protection laws that we have. I'm not saying they're wrong. I actually think it's one of the good things that we have in Europe, but it is very, very costly for a European or like a German company, for instance, to hire someone and then letting them go because we are paying for 3 to 4 months at least. You know, the salaries, like I remember in 2008 when I was basically letting myself go from a publishing house when this entire, you know, like all budgets were cut on advertising, I got a 6-month severance.
Wow.
And that was standard, right? Like this is considered to be, yeah, it was a big publishing house at Ringier. But the thing is, you know, companies need to be able to pay for that. And if you are able to pay for that, that means there is some CFO somewhere that said, okay, we're building reserves for that.
Yeah.
And all of this is having an impact again. So like imagine, okay, so less people are hiring stuff. That means there's less people in the workforce. If there's less people in the workforce, there's less software needed for them to actually do the work. If you have less contracts with multi-year bindings, that also means that you have less booked revenue and so forth and so forth. So it gets worse and worse and worse. I just wanted to pile a little bit some of my recommendations as well on top of this, like because this is very, very CFO focused, and I wanted to hear what you also think about it from my side. So I've written an article about this as well on the side right now. So like, what should we do if the outlook is not that positive? And I think that first one is always like, hey, let's focus on customer success metrics, of course, and health scoring systems. While you should not focus only on churn, I do believe what I see with a lot of consulting clients that the fundamental understanding of like, hey, when is a customer churning is usually limited to like understanding the NPS, which is a really, really bad habit. People who complain are 1 out of 100 angry ones that are never telling you anything and then just before they go. That's just one thing. So this is a relatively obvious one. So like focusing on retention, of course. The second one is like to re-examine your value proposition. And what I mean with that is that you need to start to position yourself as essential and not as luxury. That means that your roadmap has to kind of change from, hey, here's a lot of add-ons that we're going to pile onto that stuff. But like you focus back on like, hey, what is the actual core value that we have? Because nobody's going to pay for the bells and whistles anymore. So that's one of these. I also had in the pricing strategy, same thing that you said as well, like flexible contract times. Give it to the customers, even if they don't ask for it, right? Like usage-based pricing is also good because it scales with your needs rather than just the seats. And yeah, this is a big one, like help sales and marketing articulate economic impact. And that is so impossible to do if you do not understand. So if we take your example from before, if as a marketing and sales leader, you do not understand how the product really is being developed, how are you supposed to sell it in the first place? So product people need to go out and say like, okay, we're educating them the same way that we want to be educated by amazing CFOs like CJ and so forth. So yeah, I'm just going to pause here for a second, but like these are the 5 things that I think are very, very important.
I think it was your second thing. It really resonated with me. And it was like, make the main thing the main thing. So I think when times are really, really good, you can take a lot of risks about new features or, you know, let's try this different marketing experiment over here. But it's like, your core product has to be rock solid now because that's what keeps customers from leaving, really, right? And we can talk later about how the percentage of time is usually budgeted between the initiatives of like new versus existing products. But like, this is when you want to not hunker down per se, but just make sure you're rock solid on the thing that is your cash cow.
So I had this discussion really briefly in my community, and we were also starting to announce that you were coming on the podcast. And one of the people said that, yeah, well, I mean, these are good tips, but shouldn't you be doing this anyways? And I just wanted to touch on this really, really quickly because I also know that did you have an opinion on this? No, that's not what you're obviously doing in any case. So, like, what should you do different when the economy is looking like balls to the walls amazing? So when you're shifting from this fear roadmap to the greed roadmap, so to speak. Why should we care about this? It is a different focus, 100%.
Yeah. I think it's like, what's our appetite for risk here? And then what's the potential downside of this going wrong? And sometimes you have a longer leash depending on what the economy looks like. And sometimes you have a shorter leash. You still get to play the game either way. It's just on what field, you know? And so it's not to say like, hey, times are really good. We don't care about our current customers. That's not what I'm saying at all. I'm saying that if you're forced between a rock and a hard place and you have less weapons at your disposal, how do you make the most of what you have?
I think that makes a lot of sense. So now we can tie a very elegant bow around this on the budgeting side. So product people don't do budgets, as far as I know. So why does the budget matter now in this regard? And what do you think is changing? Or like, I mean, it's not just like since a couple of weeks, right? So we're talking about something that's been going on for quite a couple of years. So how are things changing in your opinion? Why does this matter? So like, where do we allocate our stuff and what's changing about it?
And so budget, I think, is like an inherently bastardized term. And people just think about like somebody in a back room keeping score. What budgeting is it's resource allocation. It's where do I put my chips on the table? And I look in a lot of ways as a finance people, they're like portfolio managers within a company, like an internal portfolio manager trying to get the best risk adjusted return for the capital that the company has. And in order to make money, you have to create product. And so there are different buckets that you can budget or allocate resources to. And the ones that I look at are growth initiatives, keeping the lights on, and then support. And then you have other stuff around like you still got to, I don't know, answer the phones and do what else we do throughout the day. But like growth, keeping the lights on, and support are the three main buckets that I put the time allocation of technical resources into.
How do you think about the split between, I don't have it in my mind right now, like what Kyle was also writing about on Growth Unhinged about this, but like R&D budgets, right? So like research and development. How do you think about the percentages there? So like how much money do we invest in a good economy versus about whatever? Like
Yeah. I was talking to Joanne Chang, the CFO of Jellyfish. They're an engineering management platform last week, and they have really good data on this. And the median company had 49% of their dollars, which is mainly people, allocated towards working on growth initiatives. So that's net new. 22% to keeping the lights on, which is like make sure that things continue to work, like the thing we already built continues to go. And then 13% to support. So customers coming and asking for like break fix stuff. And then the balance is in other. And when times get tough, you see the growth bucket recoil. So say it's at about 50% now. Maybe it comes down to 30% and you put more into keeping the lights on and support. And that means you're hardening the infrastructure that you already built and you're making sure customers are delighted with what you have.
that's a very interesting one. And I want to just be clear about the terminology here. So when you're saying growth, you're talking about also salespeople on payroll, marketing as well, probably.
No, so this is just for engineering resources and product resources. So when I say growth, I mean adding net new features to existing products or building something that doesn't exist yet. So you're thinking like for all the technical stuff that we're doing to create something we can sell, how do we allocate people's time into what they're building? But yes, there is a breakdown that you could have in your head probably for different stages of companies for sales and marketing versus R&D. But a lot of that is based on like your maturity level and if you have product market fit yet.
Yeah, no, 100%. So I think one of the very interesting things that right now are also happening, because usually that crap does not happen in isolation, is that we have also AI and some other funny things that are happening, which means that you're starting to be in commoditized markets. So people have a lot more choice than they used to have, which in the end means that, so this is why I was asking about growth. This means that the conversion rate, so the amount of people that we can convert from top of the line funnel into the product, becomes more important than just the product itself. I was talking about that particular growth. I just wanted to be clear that we're not mixing up the terms exactly on this one. So it's interesting, right? So like the bad economic outlook is kind of like taking away resources from there. But at the same time, you have AI like just like crapping on everything, making it much more important again. So, it's kind of like you have this distribution. So I'll give you a very specific example. I have no databases on this, but I think this number is correct. Out of 5 product teams, and a team I'm talking about, let's say 5 to 7 people. So engineers, product manager, designers, UX, whatever, like, a smaller unit that can produce some kind of software that is being deployed. Out of 5, there is one of them as a growth team right now. And I do think this ratio is right now increasing for 2 reasons. The first one is, yes, because of AI, over commoditization and so forth, this is starting to become more important. The second is that pure product teams that are starting to build features on top of stuff are going to get cut. So I do think that this ratio is actually going to go more to like a 2 to 8 ratio, maybe even 2 to 6, whatever. It is crazy to me that I know of companies that are running with $100 million in ARR right now, really exposed ones to the market, and they do not have a single growth team in what I just explained to you, not a single one. And they're going to have to buckle up on this one because I think they're leaving money on the table there because just, additional features is just not going to cut it anymore.
Yeah. Andrew Chen had a recent post. It was like, why all marketing channels suck right now.
Oh, I have an opinion on this, but go ahead.
I just thought it was interesting that like it felt like there's no alpha left in marketing. Like any distribution channel that you thought you had, like, oh, Google paid AdWords, that's dried up. Except working for, influencers like us, right? Like that still works, of course. But I just thought it was interesting what he was saying about
So yeah, I have some controversial takes on this too.
that there's no alpha left.
No, so I think you're absolutely right. So this is an interesting situation because you can relatively confidently predict that the overall market of SEO and Google paid ads is going to shrink. That is not a fantastic claim. That is just how we see the industry going, specifically like with AI. They haven't figured out like how to monetize the AI search, right? When everybody is just like considering like, hey, maybe I should let AI do the research or maybe even consume the product so I do not even have to go over Google. Whether this is happening fast or not is another question. So that's not the hard part of the prediction. The hard part is there going to be, as you said, an alpha or like a simple time as it used to be, like back in the days, hey, we have 200,000 to waste, let's give it to marketing, because that's usually what's happening, right? Like if you do not know where to throw money, you throw it into marketing. One of the funnier stories that I had at Microsoft was we had at some point 250,000 to spend at Microsoft Switzerland, and we produced deodorants with them. Actual deodorants.
Why? You had already done perfume with the last quarter's excess budget, or?
You know how it is. If you have excess budget, you have to spend it. Otherwise, it doesn't get allocated anymore. So the thing is, I don't know where this is going, but I also do think I have a hypothesis that influencer marketing is not going to work as good as it is right now, because this is like one of these channels where this is going. Why? Because AI is going to be really, really good in faking this stuff as well. So why influencer marketing is so big right now is because it is kind of like a stand-in for word of mouth. Like it's the next best thing that you can have for CJ recommending me something. But like there's this other kind of brand, right? So like I just don't think it's going to stay because there will be fake Leas talking about some shit that I've never said in the future, 100%. And then these channels get burned, right? So that's what I'm thinking. So what can you do about it? I think Andrew's position was, product is going to matter more. I think that's absolutely 100% fucking wrong. It has nothing to do with that. Channels are dead. That means you need to have an organization that can recognize channels that do work. So what we see is a channel verticalization, I think, where, say, you're selling to VCs. You need to have your own little community where you have in WhatsApp someone that is going to manage this. The times are over for Google Ads. And I also think it's over for like the spray and pray on LinkedIn. Same deal. You're seeing it right now. I don't know how it is for you, but for me, it's hard to reach my audience. It's really, really hard compared to last year.
Yeah. I used to be able to like just throw out anything on metrics on X and I would get a ton of subscribers. Now I think I get like 1 like and like no subscribers. I'm like, that channel is literally dead. And then LinkedIn too. What frustrates me on LinkedIn is I feel like half the posts were written by AI, but not even like with any thought. They're like lazy and it just it's just clogged it all up with just a lot of junk. And I used to have some authentic interactions on there that I appreciated, like with people like yourself, but like next to your post, then it's some guy who's probably hawking some like crypto meme coin 3 months ago who's now just using AI to say something about generating marketing pipeline. And it's hard for people to separate like the real people from the fakers.
Yeah, and it's not just that. So if you are in the majority engaging over LinkedIn, that means that the channel that you are in is starting to burn people. And that means that, even if you are staying the real deal and you're doing the right thing, and I use AI for my stuff as well, like I'm dyslexic. I want to make sure I don't make spelling mistakes. But like all of this is fine. And you can also use it for research. You can use it in really productive ways, but it doesn't matter. Because if at some point the channel is getting burned, it doesn't matter how good you are because you are living inside of this channel. So you need to own your audience. And I also made the same bet as you, which was to go on Substack, which in so many words is an own little community that we can sort of own, which is going to this point. So I do think this is also going to happen to the broader market. That's kind of like my hypothesis. So I do not think that Andrew is right on this one, that product's going to matter. No, it's not. Product is not going to come to the forefront at all anymore. Your problem is that someone is even listening.
Straight from the product person. I didn't expect you to zag there, but that was good.
Oh, yeah, man. I've been writing a lot of articles about this for years, though. I want to say I've been seeing this coming.
Peep the timestamps.
I'm one of those doomers,
Right.
But yeah, I think we went through everything, didn't we?
Yeah, that was fun. I think a lot's going on right now.
Nothing's going on. It's all good.
It's all good.
So CJ, I will put in the show notes where Substack is and some other stuff. But like if someone wants to become financially literate inside of a company, right? Do you have any either piece of advice other than subscribing to your newsletter, which I will also recommend, but is there some kind of piece of media or I don't know, any advice that you have that is maybe a little bit unusual?
Yeah. So I'll hit this from the other side of the coin because I felt that I was able to accelerate my career as a finance person when I started hanging out with product marketing because my weak spot was not understanding the value we were delivering to customers. I was seeing how much we were charging them and when they were paying us, but I didn't really understand why they were doing it. So I think on the flip side, if you're a product person or an engineering person, you understand that really well. You have a lot to add to someone who's in sales ops, to someone who's in finance, someone who's in FP&A to help them flesh out their worldview. So just find someone friendly within the company that you can bounce what you think are stupid ideas. I guarantee you they are not stupid ideas. Someone else is thinking of that same question that you have and talk to them about it. And I'll go back to my favorite question. It's, hey, can you just explain to me how we make money here? Because once you ask that question, there are so many derivatives of understanding that you can get from it. So like cozy up to somebody who's on the other side or a different department as you, because at the end of the day, what we're all trying to do is allocate resources more effectively. And if you can help in that journey, I think like you make a huge leap in your career from just like a product person to now a business owner to now a GM. And that's what I've seen all the really great product people do.
No, be cross-functional and feel the pain. Don't let just others tell you how it is.
Yeah.
I think great advice.
Yeah.
Okay, cool.
Thanks for having me on. This was a blast.
We're done. Boom! Woo! Thank you so much for listening to The Product Tea with Leah. If you don't have enough yet, you can subscribe to my podcast right now at Apple Podcasts or Spotify, or you can head to my website, leahtarin.com, which is leahtarin.com, where you can find much more of my material or just want to work with me.